Heiken Ashi is a visual representation which clearly shows trends and reversals. More importantly, it is a quantifiable technique that is easy to implement and use. While traditional price candles appeal to the more artistic and subjective judgment, Heiken Ashi is a far more evident way to display trends and reversals. Japanese candlestick patterns have a very flexible rules and interpretations in the context. Everyone translates them more or less in a subjective manner. My personal interpretations may be different from yours. These facts lead to the reality that candlestick patterns are subjective, artistic, and challenging, so traders need a more objective, quantifiable tool. And that tool is the Heiken Ashi. The very simple quantification makes the Heiken Ashi technique attractive to those who tend to take a more analytical or more precise approach. Any Heiken Ashi chart filters out price noise. As a result, trends, consolidations, and reversals are more visible and clearer to the naked eye. Sentiment, trend, and momentum are three elements every trader should take into account, and all of these are addressed by Heiken Ashi. A big advantage of the Japanese candles is that they show participants' sentiment. Candle color and body length are reliable measures for determining the degree of bullishness or bearishness. Long body candles with no or small shadows appear as a result of strong buying or selling. Excessive shadows or wicks underscore buyers or sellers' mood swings. A doji shows indecision or waiting for the next action. The closing price relative to the open is a clear indication about the bullish or bearish clouds hanging over the trading period. Heiken Ashi candles make it easier to identify and follow trends. Green bodies with no lower shadows show an uptrend. On the other hand, red bodies with no upper shadows represent the price being in a short or longer downtrend. A doji-like modified candle with shadows emerging after an uptrend or a downtrend suggests a reversal. Price consolidations are translated as sequences or two or more Heiken Ashi doji-like candles. With Heiken Ashi candles, the sentiment is measured by the color and the size of the candle bodies, together with the position of the shadows. Big green and red bodies are features of solid underlying trends. Smaller bodies warn about trend exhaustion. A doji-like candle that follows a sequence of green or red modified candles raises caution about either a reversal or the beginning of a consolidation period. While Japanese candlestick theory requires many definitions and flexible interpretation rules for most common and exotic patterns, the Heiken Ashi technique works with only 5 simple rules. A sequence of green bodies identifies an uptrend. A sequence of red bodies identifies a downtrend. The uptrend gets stronger with longer green bodies and no lower shadows. The downtrend gets stronger with longer red bodies and no upper shadows. The trend gets weaker with smaller bodies and possibly with the emergence of both lower and upper shadows. A consolidation is revealed when a series of smaller bodies with both upper and lower shadows emerge. A trend reversal is likely with the emergence of a small body with long upper and lower shadows, a doji-like candle, or a sudden color change. Multiple timeframe analysis in trading requires an increased attention because of the better odds in catching trends and remaining in them longer. Obviously, if an uptrend is just starting in the daily, weekly, and monthly timeframes, the winning odds for a long entry now are far bigger than when the entry is initiated in the daily timeframe, with weekly and monthly charts casting bearish signals. The ideal scenario is to have trend alignment in all 3 horizons and to initiate the trade as early as possible in the trend. As a compromise, 2 consecutive timeframes may replace the ideal scenario of 3 timeframes. So, one option is to work with only 2 consecutive timeframes instead of 3 and to apply a simple strategy. To buy when the current modified candle color changes from red to green in 2 consecutive timeframes, or sell when the current modified candle color changes from green to red in 2 consecutive timeframes. Another great strategy involves the RSI indicator. There are 3 horizontal lines plotted on the RSI indicator window, the 30, the 50 and the 70. The RSI 50 level can be used as a strong signal to confirm the different kinds of trade setups using Heiken Ashi. I mainly prefer to use the relative strength index for centerline crossovers. A movement from below the centerline to above indicates a rising trend. A rising centerline crossover occurs when the RSI value crosses above the 50 line, moving towards the 70 line. This indicates the market trend is increasing in strength, and it is seen as a bullish signal until the RSI approaches the 70 line. A movement from above the central line to below indicates a falling trend. A falling centerline crossover occurs when the RSI value crosses below the 50 line on the scale, moving towards the 30 line. This indicates the market trend is weakening in strength and is seen as a bearish signal until the RSI approaches the 30 line. A simple strategy would be to buy when the current modified candle color changes from red to green and the RSI is above 50, or to sell when the current modified candle color changes from green to red and the RSI is below 50. This way, you have additional confirmation that you are in a healthy trend determined by both Heiken Ashi and the RSI center line. For an uptrend, you want to see the Heiken Ashi trend built primarily by bullish candles and absent of lower candle wicks, with the RSI above 50. When the price is shooting up, the price action creates very little to no lower shadows. The bearish scenario has the same function as the bullish one, but in the opposite direction. This means that it is built mainly by bearish Heiken Ashi candles. You want to see a strong bearish trend on the Heiken Ashi graph that has very little to no upper candle shadows, in addition to the RSI below 50 level. Here are some examples of uptrends and downtrends using this approach. The second strategy involves the ICHIMOKU indicator. The ICHIMOKU consists of several components which give it a unique capacity to detect trends and when the trend reverses. One of the components is the Kumo cloud, which is one of the most unique aspects of the ICHIMOKU indicator. The Kumo is typically looked at in terms of support or resistance. If it's thick, then the support or resistance is strong, depending on the position of the price in relation to the cloud. By contrast, if the cloud is thin, then the support or resistance levels are considered weak. Generally, if the price is above the Kumo, then there is an uptrend in place and/or more buying opportunities. If the price is below the Kumo, then it is under resistance, and it's better to be looking for shorts instead of longs. The longer price action stays above or below the Kumo, the stronger the trend, and the more support or resistance the Kumo offers. A simple strategy would be to buy when the current modified candle color changes from red to green, the Kumo cloud is green, and the price is above the cloud, or to sell when the current modified candle color changes from green to red, the Kumo cloud is red, and the price is below the cloud. For an uptrend, you want to see the Heiken Ashi trend built primarily by bullish candles and absent of lower candle wicks and the candles above the Kumo cloud. A strong bearish trend consists of Heiken Ashi that has little to no upper candle shadows, in addition to the price below Kumo cloud. Here are other examples of trends using Heiken Ashi and ICHIMOKU cloud. If you learned something new and found value, leave us a like to show your support, and also don't forget to subscribe and hit the bell icon to stay in touch with new uploads. Until next time.